is checking. Little coaster. Alright guys, welcome to my newly renovated set, which I hope you guys like. I'm thinking about, I should have added some stuff here, like what we're going to talk about today. Fix that, huh? Alright, take two. If you guys are here to know more about pre-approval letters, this is the video. How are you? Good morning. My name is Marlon Manuel, Las Vegas Realtor here in Las Vegas Realtor here in Nevada. I hope you guys are having a good day. Today we are going to talk about pre-approval letters because you want to get a house. If you've seen my previous video about 10 steps in buying a new home, this is the first step. You, the lender, and the realtor wants to put things in perspective, make sure that it's within your means, within your interest. Pre-approval letters, you want to know how much can you afford, how much you would want to budget. Is it within your means, within your income, within your debt, within your expenses? All of those things are a factor. The good thing about it is this is not set in stone, so you can always go to any lender, shop around, shop as many as you want. Are they gonna ding your credit score? The rule is if you ask for the same requests for the same house, they're not gonna ding you as much. I say as much because if you go over 6 credit checks within a given period of time, maybe about, I don't know, 2 weeks or maybe a month or maybe 3 months, then it's gonna hurt. So I would suggest keep it between 4 to 6 at the most credit checks for a pre-approval letter. That way you can maximize your potential getting the best and highest loan estimate around within your range and around within your budget. Now that you know that it's not scary to get a pre-approval loan, where do you get this? So the traditional way is you go to the bank and you talk to a consultant, loan officer. But nowadays I believe that online resources and online banks are gonna give you a rough estimate of how much you can afford. I always suggest that if you can, talk to somebody, a real person that is actually most knowledgeable. That is much more preferable. So now you know where to get it. What are they going to ask for? What are the things that you got to know? What is the process? So the main thing that they're going to be asking for is your income. 2 things. You can either let them know that you're employed or you're self-employed. If you are employed, the main thing that they want to know is how long have you been working there. General rule is they want about 2 years of continuous work from the same employer, at least 2 years. The longer the better, but general is 2 years. Perhaps, this is just my speculation, perhaps because of COVID-19, things are a little more flexible depending on the lender. So always ask them what are the specifications of their requirements. Let's say you're not a full-time employee and you've just been getting part-time jobs within a given period within 2 years. What they're gonna do is they're gonna average those 2 jobs and put it together and come up with a result. So if you're self-employed, for example, you're an independent contractor or maybe an Uber driver or you're a business owner, something similar, then they're gonna be asking for your 1099 and they're gonna see how much consistency would that be. Definitely a big factor, definitely something that they're gonna check out, and later on they're gonna assess your assets as well. We're gonna talk about that in a second. The basic premise is the lender wants to know if you're a verified employee or you have a continuous source of income. To follow that up, now that they know your income, they want to know how much debt you have. The debt that I'm talking about are anything that you have been financing. Let's say you have a previous home, that's a mortgage. You have a car payment, that's a debt. Maybe you have furniture on finance. Maybe you have your gaming system, your sound system on finance. Or maybe you have college debt of some sorts. Oh, and also don't forget, your credit cards are also major debts. What the banks are most likely going to do, they're going to check your income versus your debt.
According to Investopedia, lenders prefer to see a debt-to-income ratio smaller than 36%, with no more than 28% of that debt going towards servicing your mortgage.
So according to Investopedia.com, lenders like it if it's under 36%. And that's kind of the general rule. 36 is dependent on the lender. They say that if you pay over 30% on housing or mortgage, then perhaps you either want to get more income or you want to lower your debt. The next thing that they're going to check out is how frequent or how consistent do you pay your debt. There's two types of credit score inquiries. There's a hard and there's the soft. They're going to run a soft inquiry on your credit score. From what I know, the hard inquiry is one that is going to ding your credit score, and if it's going to affect it, it's going to lower it. Definitely something to consider if you're going to be financing or making a big purchase. With the soft credit inquiry, that's basically checking if you have any delinquencies. The best times that people use the soft inquiry is when perhaps you're getting a new apartment. They're going to do a soft inquiry to check if you have any delinquencies or balances. The general rules are as follows. So they're going to check on how many applications of credit cards have you had in a period of time. They're going to check your payment history, which is, I think, the most important, because if you have the money and you're not paying it, that's a definite red flag for a lot of lenders. Credit utilization. So depending on how many credit cards you have, they're going to check on how much you use it, how much you pay it as well. Derogatories, if you have any missed payments or if you have any collections are following you, those are red flags. So if you are an authorized user, maybe from your parents, you're under their credit cards, but you can still use it, that's also a factor. Maybe it's a good thing because you're building credit without having your own credit card, but you're kind of piggybacking from your parents, and that's a good way to build your credit too. If you miss a payment and you have disputes with the creditors, then that's something that they're going to check as well in your credit history. Last but not least, the lenders are going to check your assets. If you have maybe a 401k, or maybe you have a Roth IRA or an IRA, if you have savings, if you have stocks, if you have a previous home too, that's definitely an asset. They're going to check and consider those as assets. Lenders think that that's a good thing because they may see that as collateral. For example, if I want a zero down kind of loan, zero down payment kind of loan, but I have money in the stocks, like I have $100,000 in the stock market, but I don't want to cash it out, so they're gonna give me the zero down payment loan with the promissory that if things are needed to be liquidated, I can always liquidate my stocks if things happen in a negative way. So it's a risky move for the bank, but then again, you're getting a zero down payment loan, and that's all that matters. I think that's all the things that are needed to be considered when you're getting a pre-approval loan. Thank you guys for watching. Appreciate it. Oh, by the way, and like all finance channels, you guys can also get your 2 free stocks here with Webull, valued up to $1,400. And how sweet is that? And if you guys like this video, please give it a like. Consider subscribing. Thank you guys for watching. I'll see you guys on the next video. Ciao. Interest rates are low and it's a good time to buy. With that said, you're gonna need your pre-approval. But without this pre-approval letter, nobody's gonna take you seriously. So that's it, guys. So those are the things that I think the pre-approval letter. I think I'm too Hollywood for Hollywood. My ego's too big. My big head's phenomenal. Act like a gondola, neck like I'm on a boat. Too quiet for fame.